When we hear the word investing, the first thing that comes to mind is usually stocks. Some of us have heard about bonds in the way we have heard about a lot of financial terms. Enough to recognize the word, not enough to explain it. And then there are ETFs, which beginners often find confusing because they sound technical even though the idea behind them is simple. I remember when I first started looking into this. I thought each of these was a completely different world with its own rules. They are not. They are three pieces of the same puzzle, and once they click, almost everything else makes sense. Here is the truth that ties this all together. Stocks, bonds, and ETFs are the basic building blocks of almost every investment portfolio in the world. Pension funds use them, hedge funds use them, individual investors use them. The mix changes, but the building blocks are the same. So in this episode we are going to walk through each one. What it is, how it actually works, what it is good for and what it isn't. So by the end we will know exactly how to think about them when we start investing. Hey, I'm João and welcome back to Investing Basics for Beginners. In episode 2 we covered how the stock market works, the supermarket analogy, supply and demand, why prices move, and the role of indexes in showing us the broader picture. Now we are going one level deeper, into the actual products we can put in our basket when we start investing. This episode matters because once we understand the difference between stocks, bonds, and ETFs, almost everything else in the investing world becomes easier to follow. Most investment products we will ever encounter are some combination, packaging, or variation of these three things. Get the foundation right and the rest stops feeling confusing. Let's start with stocks, because they are the most familiar. A stock is a piece of ownership in a company. When we buy one share of Apple, we don't own enough to influence on how the business is run, but we do own a fraction of it. The same is true whether we are buying a share of Tesla, Coca-Cola, or any other publicly traded company. We become a part owner. The way stocks make us money comes in two forms. The first is growth. If the company expands, sells more, becomes more valuable, the price of our share rises along with it, and we can eventually sell those shares for more than we paid. The second form is dividends, small portions of the company's profits that some companies pay out to their shareholders, usually quarterly. Not every company pays dividends. Many growth-focused companies reinvest all their profits back into the business instead. But for the ones that do pay them, dividends are a way that ownership translates into actual cash flow into our account on a regular basis. The trade-off, and it's an important one, is that stocks carry real risk. If the company struggles, weaker sales, bad management decisions, an industry shift, the price of our shares falls. If the company fails entirely, the shares can become worthless. This is why individual stocks can be exciting but also unpredictable. Owning shares in a single company means our outcome is tied directly to that company, for better or worse. There is also something about individual stocks that's worth being straight about. A lot of what we see about specific companies on TV, on YouTube, or on a social media isn't really there to inform us. Some of these people are just pushing a narrative. Sometimes someone goes on a big channel, talks about how great some company is, sounds like they really know what's going on. But we don't know what they are doing with their money. Sometimes the person talking about the company is betting against it at the same time due to inside information. They get everyone excited, people buy in, and then they make money when the company reports bad numbers and the price drops. This has happened and people have been caught doing it. I'm not going to name anyone, that's not the point. The point is that someone sounding confident on a screen doesn't mean they are being honest with us. And sometimes they got a good reason not to be. The other thing is, who is actually on the same side as us when we own one company's stock. We assume the people running it want it to do well as much as we do. That's not always how it works. A lot of CEOs barely hold any of their own company stocks. Some get paid in shares and sell them pretty much the day they get them. Their money isn't really in the company, ours is. So their interests and ours aren't always pointing the same way. When we put our money into one single stock, we are trusting a lot of stuff we can't actually see. So that's why buying individual stocks on your own is riskier than it looks. If you really do your homework and understand what you are buying, fine, it can be done. But if you are just following whatever trending, buying something because it blew up on Twitter or because some confident guy told you to, that's not investing, that's guessing. And that's usually how people lose money. Picking individual stock isn't impossible, but it's harder than it looks, and even professionals with full-time research team have a hard time consistently picking winners over the long run. We will come back to that in the next episode. Now let's look at bonds, which work in almost the opposite way. If a stock is ownership, a bond is a loan. When we buy a bond, we are not becoming a part owner of anything. We are lending our money to a government or a company, and they are agreeing to pay us back over a set period of time with interest along the way. So the relationship is reversed. With stocks, we are an owner. With bonds, we are a lender. The mechanics are pretty straightforward. A bond has a face value, the amount we will get back at the end, a coupon rate, the interest percentage we will receive periodically, and a maturity date, when the loan is fully repaid. If we buy a 10-year government bond with 4% coupon, we will receive 4% of the face value every year for 10 years, and then get our original money back at the end. And we are not locked in for the whole 10 years either. If we need our money sooner, we can sell the bond to another investor before the end date. Bonds trade on the market a lot like stocks do. What we get for it depends on where interest rates have moved since we bought it, but the option to get out early is always there. Because bonds promise fixed payments, they are generally considered safer than stocks, especially government bonds from stable countries, which historically have a very low risk of defaulting. The trade-off, and there is always a trade-off in investing, is that the returns are usually lower. We are getting predictability, and we are paying for that predictability by accepting slower growth. The mental model is to think of bonds as the stabilizing element in a portfolio. They don't grow as fast as stocks, and during good market years they often look boring by comparison. But during bad years, when the stocks are dropping, bonds tend to hold their value or even rise. Often because when the economy slows down, interest rates get cut, and older bonds paying the higher rate become more valuable. That softens the overall ride. As we get closer to actually needing the money we have invested, bonds become a way to protect what we have built without watching it swing wildly with the market. Now we get to ETFs, the building block that for beginners is probably the most useful to understand well. ETF stands for Exchange Traded Fund, but the easiest way to picture it is as a basket. Instead of buying one stock or one bond, an ETF lets us pay a pre-assembled collection of them in a single transaction. One purchase, dozens or hundreds of underlying assets. The most common type is an index ETF, which tracks a market index like the S&P 500. When we buy a share of an S&P 500 ETF, we are effectively buying tiny pieces of all 500 of the largest US companies at the same time. Apple, Microsoft, Google, Amazon, Coca-Cola, dozens of banks, dozens of healthcare companies, and so on. Our money is automatically spread across all of them in proportion to their size. This matters for one big reason: diversification. If we own shares in only one company and that company had a bad year, our portfolio would feel it. But if we own a slice of 500 companies through an ETF, a bad year for any single one of them barely moves the needle, because the others are doing their thing. The risk gets spread out across the whole basket, which is exactly what we want as long-term investors. The other thing ETFs have going for them is costs, because index ETFs simply track a list of companies rather than relying on a team of analysts trying to pick winners. Their fees are extremely low, often less than 1/10 of 1% per year, compared to traditional managed funds that charge 1% or more. This difference compounds into a huge gap over decades. For beginners, ETFs are usually the smartest starting point because they solve the two biggest problems at once. They automatically diversify our risk, and they keep our costs near zero. This is also where I started, and they are still the core of how I invest today. Instead of trying to figure out which individual stock to buy, we get exposure to hundreds of them with a single purchase. So, it is how the three pieces fit together. Stocks are ownership. They offer the highest growth potential over the long run, but they also carry the highest short-term risk and volatility. Bonds are lending. They offer lower growth in exchange for more stability and predictable income. ETFs are baskets. They let us hold many stocks, many bonds, or a mix of both, all in a single, low-cost investment that's automatically diversified. In practice, very few investors hold just one of these. Most portfolios are mixes. Some allocations to stocks for growth, some allocations to bonds for stability, sometimes adjusted over time as goals changes. Younger investors who have decades ahead of them often lean heavily towards stocks because they have time to ride out the volatility. Investors close to needing their money tend to shift toward bonds because protecting what they have starts to matter more than growing it further. The exact mix depends on personal goals, age, income stability, and risk tolerance. There is no single right answer that fits everyone. The same building blocks can be assembled differently for someone in their 20s versus someone in their 50s, and both can be right. Let's bring it back to the simple version. Stocks grows our wealth, but with more risk and volatility. Bonds protect our wealth and provide steady income, but with slower growth. ETFs give us the balance and diversification that fits how almost every long-term investor should think about their portfolio. As beginners, we don't need to gamble on which single company will be the next big winner. Starting with broad ETFs is usually the smartest move. It's the equivalent of buying the whole supermarket instead of trying to guess which one product on the shelves will become a hit. We get to participate in the broad growth of the economy without needing to be experts at picking individual winners. In the next episode, we are going to tackle one of the biggest debates in investing: active versus passive. Should we try to beat the market by picking stocks and timing trades, or should we go passive and let broad index funds do the work? We will break down both approaches, walk through what the data actually says, and explains why most beginners and even most professionals end up better off going passive. If this episode helped clear up the building blocks, hit subscribe so you don't miss what's coming, and I will see you in episode 4.